The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Easing inflation, lower bond yields, but maybe not enough to convince some traders to buy into that dip. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Isabel Lee. We're kicking you off through the closing bell on this Wednesday. So we got over the hump day, and you're looking at a NASDAQ that's off of its session lows, but still down. It's down by 0.6%. Of course, we saw a softer than forecast inflation print earlier today, but still, that optimism is overshadowed by the chip rout. You're looking at the semiconductor index down by nearly 3%. And that inflation print is why you're seeing the U.S. two-year Treasury lead at this level right now. We have traders dialing back rate cut bets. In fact, they're looking at a December rate hike right now. And of course, SpaceX, why not for fun? Remember, Romaine, when it went public on June 12? Well, this is the first time since it hit below the 135 price level that it was famous for.
Going to be interesting to see the price action as we get closer to the closing bells. We actually started off on a relatively positive note for stocks on the back of that drooping U.S. producer price inflation growth. That 12% drop in gasoline, it was a big help, but there was also relief elsewhere. Lower warehousing costs, lower airfares, lower portfolio management fees, and even some food items like grains, eggs, and pork, they got, well, just a tad bit cheaper. However, we did get a reminder that the specter of the reinflation of inflation still looms, particularly for goods and services tied to the AI boom. Prices on computer software and accessories in yesterday's consumer CPI report, that increased for the 7th month in the past 8, while a measure of what producers pay for computers and equipment rose for a 12th straight month. And then you had ASML, which sits atop the AI chip supply chain, the sole supplier of those advanced lithography machines. Now we're learning, based on a report from the information, that it is mulling, marking up its price tags once again. And then, of course, there's the oil story. While Brent crude sits below the roughly $90 a barrel average since the Iran war began in February, refiners of that oil here in July still struggling to rebuild some of those supplies. That's reflected in crack spreads, or the difference between what a refiner pays for the crude and the price it charges for the finished product like gasoline. That spread at historic highs, and some folks don't think it's going to narrow anytime soon.
I think oil is going to stay sticky for longer. I'm not sure it's going to be in crude, though. I think the refined costs or crack spreads are where you're going to find it's going to take a lot longer for that to come down.
And Isabel, of course, that is the view of the head of one of the biggest airlines out there. I think traders are kind of in the same boat.
They're definitely in the same boat. And I do want to stick with oil, Romaine, because all the points you raised were very interesting. And if you look at this chart, it's a very fascinating chart because the price of crude, which is the white line over here, has fallen much faster than the price of gasoline, diesel, and jet fuel. And that's because refiners have struggled to keep up with demand. So normally crude oil and refined fuel prices move largely in tandem. But disruptions to refining capacity, especially in Russia, have kept refined products relatively scarce. And this allowed fuel prices to stay high even as crude becomes cheaper, and this then widens refiners' profit margins, which remain, as you just told us, is known as crack spreads.
All right, well, let's kick things off to the close today with Jeff Currie, Senior Advisor over at Carlyle and Executive Co-Chairman over at Apex Markets. And Jeff, I do want to start with sort of what read we should take, if at all, from what is effectively one of the highest crack spreads that we've seen since the mid-'80s, relative to, I guess, the relative fade that we've seen in crude oil futures themselves.
Well, I think when we think about oil, it was impacted by, like I could say, when that MOU came out, it was like popping a pimple. There was oil trapped behind the strait, and then it all came out suddenly, like over 120 million barrels. You know, some estimates put as high as 150 million barrels. That hit crude really hard as it came down, but obviously you can't refine it immediately and put it into products. But at the exact same time, Ukraine started striking deep into Russia, like 1,300 kilometers inside Russia with precision drone strikes that were taking out what we call the CDU, crude oil distillation unit. That's the primary tower. Some of these things are going to take years to rebuild. The damage was so extensive, it's taken out more than 50% of the refining capacity out of Russia and has led to crude oil shut-ins. So not only have we now lost all of the Straits of Hormuz again, we've also lost the crude oil and the refineries in Russia. So the situation in energy, I would argue, is pretty dire. And the other thing I want to point out is that we've exhausted all the insurance policies in round one of the Straits of Hormuz. whether if it is inventory buffers or whether it is China with flexing its economy and be able to survive the downturn. So it's a very different situation in this round two than what we saw in round one.
Well, square the circle with me, because I mean, you get this messaging coming from the Trump administration. I understand they're going to talk their side of this story, but they talk about this oil glut and all the tankers out there that are ready to sort of pick up the slack here if and when they finally get the situation in the Strait of Hormuz taken care of here. With no buffer, no cushion, why is there still a lot of optimism out there, not just from the administration, but even from some of the corporate CEOs that we've heard from?
I think they have witnessed the fact that nothing happened in round one. And I like to say commodities are spot asset. They price today's fundamentals. We were burning through the inventory cushion buffer. We didn't have shortages. We had a deficit, meaning that demand was above supply and you were drawing the inventories. We didn't run out of oil. This time around, why do we have products trading at these all-time high levels, and you have diesel, I think in New York Harbor is like $130 or $140 a barrel? Because we are now witnessing the probability of running into real shortages of products. But eventually, there's still enough refining capacity as you'll burn through a lot of this crude, particularly of China. And from what I understand, the margins are big for exports. They lifted the export ban out of China. Those refineries are going to come back and start processing that. So you're going to see the rise in crude as you move closer to the product prices. But I think the main reason why there is a high level of confidence this is not going to be bad is, like I call it, the abundance illusion. They're looking at the inventory draws. China helped out with flexing its system, and we didn't see the shortages. So everybody's convinced round two you won't see the shortages. The situation, this is it. And both sides have, entrenched themselves. Oh, one other fact that makes this one different. Saudi and the Houthis are at it. Mm-hmm. The Houthis control the Red Sea. They can take out Yanbu, which was the diversion export for Saudi Arabia. So the situation this time around is just far different and far more dangerous.
Jeff, do you think that demand destruction can offset supply shortages, or do you think we're entering a new era in which oil prices are just structurally higher and that's the new normal?
I was arguing before this ever happened, we were going to enter a new area where all commodity prices, whether if it's oil, metals, agriculture, and the rest of them are going to be structurally higher. In fact, everything was going that direction until the ceasefire in April, whether it was metals prices or what. And a part of that is, we call it the revenge of the old economy, that you need to have investment in these old economy, asset-heavy industries that were starved of capital in favor of asset-light, like technology. So the underlying fundamentals are very different. And I completely agree. We're in a period where hard assets, the halo trade, I like to define halo as hard assets, local operations, meaning we're going to rebuild our supply chains, energy security, all of these, defense, all play into this, which are going to lead to higher prices. So, I think that this is just part of a sequence, whether if it was, the first invasion of Ukraine with Russia, back in 2022, or the Straits of Hormuz, or the next round of Iran, Russia, all of this is the deglobalization theme in process, which just leads to higher commodity prices.
So markets seem comfortable with oil in the $70 to $80 range. At what price do you think that this will economically slow growth and maybe change central bank thinking?
The question around slowing growth is, it's not so much the price of the commodities. That's a relative price thing. The question on inflation is, do you end up with higher overall price levels? So the commodities and oil are a relative price movement. The inflation question and the rate hike question is, does this lead to broader inflationary pressures? I'm not a big believer in the cost push inflation, but I think the question around growth is a very interesting and important one, because if we end up with shortages, that's how you end up with impact on growth. Everybody likes to tell me, oh, well, Europe survived 2022. It survived, but it lost 25% of its energy-intensive industrial output. That's the growth problem. And when we think about what happened in Europe, I mean, if this thing extends on, you don't have the products, you don't have the oil, it will hit growth. There's no other option. And the insurance policies are gone. I also want to point out there is no strategic petroleum reserve for products. So the ability to find ways to get out of this starts to become extraordinarily difficult.
Hey, Jeff, before I let you go, I do want to get your thoughts on what's going on in the energy sector outside of geopolitics. And this has more to do with energy intensity, the needs for this AI build out and boom. Coming off that PJM disclosure yesterday and everything we know about this build out, do you have any sense here that we will find some equilibrium anytime soon with regards to supply and demand?
No, I think we need to start spending money. You got to see FID, whether if it's upstream in oil and gas, downstream in refining, and metals in mining. All of these sectors are severely underinvested. You look at metals and mining, CapEx is down 35% from its peak. You need a lot of metal in those data centers. And you need metal for the grid. You need metal for transformers. You need metal for turbines. We need oil and gas to burn in them. We got to get to a point where commodity prices are high enough to attract capital back to the sector. You need higher return on investment to compete with the asset-light group. And the asset-light group, their returns are coming down. You look at the hyperscalers, these guys are commodity guys. They're in a cyclical business. It is cyclical. They need to be re-rated, and we need to see the commodity markets re-rated. But the reason why investors don't touch them is they're such a small part of the overall indices now. You go back at its peak in the last cycle around 2014, energy was roughly 18% of the S&P. It runs around 3% now. So even if it doubled, a portfolio manager who's running a broad portfolio looks at, I can miss out. And we needed the commodity prices to move higher to get that capital to come back in the space to give the build out in the underlying production to be able to accommodate the AI, the electrification, the data center boom. So we still have a long ways to go here because you got to get the FID up.
All right, Jeff, great stuff. Really appreciate you taking your time with us. Jeff Currie, Senior Advisor there over at Carlyle. And just an update for our viewers, we are waiting to hear from the President of the United States speaking at an event in Pennsylvania about investments in the defense space. But when we come back here on The Close, we're going to continue to check in on the markets, and we're going to check in on real estate. We're going to talk with one of the world's largest real estate managers on why he says right now is a great entry point for the group. We'll be back in a moment right here on The Close, right here on Bloomberg.
June PPI signaling tamer inflation thanks to a decline in energy costs. The data helping scale back bond traders' bets on a Fed rate hike later this year. Joining us for more, I'm pleased to say, is Liz Thomas, Chief Market Strategist at SoFi. Thank you so much for joining us in person, Liz. So we got the PPI report earlier today, and I'm looking at the inflation print. So if it's driven more by geopolitical and supply side forces, how effective are interest rates to begin with, and how effective are higher interest rates?
Well, I'm of the mind that we're not going to get rate hikes this year. Now, that's probably a bold statement because there's still a lot of year left to go, and we know that the war has already re-escalated after some hopeful de-escalation in June. But both of the inflation prints we've gotten this week, so CPI yesterday, PPI today, were weaker across the board. And I think that's an important point to key on for investors. So yes, oil prices came back down and that helped inflation relax quite a bit. But we had broad-based inflation cooling, and that's really, really important. I think the idea that the market is celebrating this is good, but also Kevin Warsh's comments about this is not mission accomplished are also intelligent as well. So we still need to see a trend of cooling inflation, and we need to see a trend of cooling inflation on some of those components that have been troublesome.
So do you think markets are then overestimating inflation risks or maybe underestimating the growth potential?
I think right now markets are overestimating the likelihood of a rate hike in 2026. But if you look at long-term inflation expectations, things like the break-even rates, the 2-year and 5-year break-even rates, they're actually pretty tame. And you've got 5-year inflation expectations, according to break-evens, around 2-ish%, 2 years below 2%. So I think the market is actually correctly pricing those. But it's the rate hikes and what's going to happen with the Fed. And given that we have a new chairman trying to set expectations correctly for the next 6 to 12 months.
I'm curious how much you think markets should pay attention to oil. Not that they shouldn't pay attention at all. And I just want to point out for our viewers, we're getting a red headline crossing the wire right now. New strikes once again on Iran. I think it's like the 6th straight day. The president speaking in an interview on another network saying he expects oil prices to yo-yo around. But at the end of the day, we're still, what is it, $85 on Brent crude, which is actually below the average of where we were over the last few months coming out of the start of the war in February. I mean, unless we start to spike back up into the hundreds, is it a worry for investors, for equity investors?
It's a worry if it happens for a long-term period. And to your point, at $85 a barrel, that's still far below getting close to $120 a barrel, where it was at the peak during wartime. So we're still, I think, right now in an okay place, and investors seem to be looking through this once again, I think in hopes that it does de-escalate and we come to some sort of an agreement in the near term. If oil prices elevate, let's call it above $90 a barrel, there's not a magic number, but let's say $90 or $100 a barrel and stay there for a prolonged period of time, then there is a problem because that does bleed through into a lot of other parts of inflation and it hurts consumer sentiment. And as we know, consumer sentiment is one of the most important things to the U.S. economy.
What are your thoughts on the earnings season, though? Because I remember when this war kicked off, someone on this program made a good point. He said, I'll start to worry about it when it shows up in the corporate bottom lines to a certain extent. And while there are some companies that have clearly been affected by this, across the board, we had a great earnings season, the last earnings season. Expectations for this one are high. We just had we had one airline report last week, another one reporting today, and they're doing well. So are you optimistic that at least in terms of corporate fundamentals, that will remain supportive for a considerable amount of time?
I do think earnings season is going to be healthy. Expectations, as you mentioned, are very strong. We have to keep in mind, though, as investors, earnings and the market don't move at the same time. So the market tends to peak before earnings peak. So earnings could continue to be very, very strong, even with a market that's moving sideways. And I think through summer and maybe even into early fall, we're likely to see volatility, not just because we've got a new Fed chairman that the market is trying to figure out, but then we're going to hear a lot of rhetoric around midterm elections and different policies that could affect markets going forward. So keeping in mind that earnings are likely to stay strong. I don't think that we're slowing down this AI train anytime soon, but that the market may do something completely different regardless of those fundamental results.
Yeah, those ASML numbers today kind of show that that AI story isn't slowing down. We get TSMC in a few hours as well. Liz, always great to have you. Liz Thomas, Chief Market Strategist over at SoFi, as we count you down to the closing bells. We're going to take a look back at what has been a big couple of days for the big banks. We're going to analyze the latest results that we got this morning, including from Morgan Stanley. That's coming up next here on The Close, right here on Bloomberg. Morgan Stanley shares fractionally higher on the day, but that's going to be good enough for a record high should it hold. This on the back of its latest earnings report that sailed past Wall Street expectations. Joining us right now is Jason Goldberg, senior analyst over at Barclays. He's got an overweight on the stock. Jason, I want to start off with the wealth management business. That was obviously been their bread and butter for so long. And we look at some of those numbers, $148 billion in net new assets in that business. Is that a one-off, or is this really kind of that long-term trajectory that we've seen the CEO really push for?
No, clearly that business has shown really good trajectory over the last several years. Ever since kind of the E-Trade acquisition, kind of expanding the funnel, you've seen growth throughout that business. This quarter was maybe a little bit elevated given the market backdrop, as well as kind of strong IPO activity aiding the workforce solution. But we see strong momentum in that business and expect it to continue as long as the markets hold up.
Well, I am curious about that, like how much the capital markets business ties into that, obviously with the mega IPO of SpaceX. And I know a lot of people are saying, okay, that's a one-off. But, just today there were headlines that Anthropic's now getting ready to put its IPO out there on the tarmac sometime soon here. Does this become sort of a multi-quarter tailwind given the capital markets pipeline?
Listen, we think there's a very strong secular growth story tied to their wealth management business. They have several ways to gather in customers. The world is continuing to be a more complex place. There's more solutions out there. There's more assets to invest in. And advisory is needed now more than ever. So we expect continued growth. Obviously, the market will fluctuate, and so will assets. But, on average over time, the markets and new assets should trend higher.
Jason, what about loan growth? We're seeing the loan growth beginning to recover while credit quality remains resilient. Do you think that investors are maybe expecting a stronger than expected economy, and they're correct about that?
Yeah, no, clearly the results so far, do point to that, right? Loan growth has been fairly strong, really across, all categories. C&I has been particularly strong, but you're also seeing kind of CRE after a multi-quarter kind of headwind start to inflect. The consumer continues to borrow. And to your point, credit quality remains, very, very, very stable. Every quarter we kind of look for cracks. And despite the fact we have elevated interest rates, elevated inflation, net charge-offs are flat to down this quarter. Non-performing assets are lower. Criticized assets are lower. So, all indications point to kind of a good quarter, as the regionals continue to report.
And we have net interest income. They're largely in line, but margins remain under pressure. Do you think that the biggest driver for earnings going forward is maybe lending or capital markets?
Listen, for the biggest banks, clearly you've had a, blowout capital markets quarter, both from investment banking fees, and trading. And the backdrop for investment banking, particularly, IPO activity and M&A, remains quite strong. But this will likely end up being also the best loan growth quarter in the last few years. And, some of that's tied together. Some of it, is broadening. But, we continue to feel good about both those areas.
All right, Jason, always appreciate it. Jason Goldberg there, senior analyst over at Barclays. A closer look at Morgan Stanley, Isabel, and now we've got basically the biggest banks in the U.S. out of the way. They all pretty much exceeded expectations. Expectedly, to put it glibly there. But a big question now is, does that continue for the next couple of quarters?
Yes, and is it just a one-off? You brought up a great point earlier. We've seen a pipeline of mega IPOs. I mean, maybe more to come at the end of the year, but is this really just a one-off that we can all celebrate? But is it really sustainable?
Well, bank stocks right now, one of the bright spots in this market. Also seeing a little bit of a bid into some of the communication services names. But obviously, the next big story is going to be where yields go. And we've continued to see this up and down again today. And that seems largely based on that PPI report we got today and the CPI yesterday.
That and oil. You've mentioned a lot of times oil is a story here. I mean, how much is it a macro driver? I mean, are investors just really getting used to a oil price that's structurally higher? Jeff Currie made the point earlier that maybe this is a new regime, Romain.
A mixed bag in equity markets, though, with the Dow and the S&P in the green. The NASDAQ composite in the green, but the NASDAQ 100 down as the tech sell-off continues. When we come back, a more constructive conversation about real estate with Todd Henderson. And you are looking at a roundtable of U.S. corporate executives. We are awaiting the President of the United States, Donald Trump, to head into that room in Carlisle, Pennsylvania, for a broad-based summit dealing with U.S. defense advancements. We'll bring you sort of any news that we get from that as soon as the President enters the room. But meanwhile, we do want to get back to markets. I'm Romain Bostic.
And I'm Isabel Lee.
And we're counting you down to the close. And we want to talk real estate right now. DWS, one of the world's largest real estate managers, they're actually saying that economic conditions are actually opening up a great entry point for investors. They're flagging a rare divergence between prices and construction costs that tends to lend to substantial returns. Joining us right now is the head of real estate for the Americas at DWS, Todd Henderson. Todd, great to see you.
Great to see you too.
So let's talk about the value proposition, because when I hear entry point, I thought the entry point passed a while ago. What are we talking about exactly?
Yeah, well, I think there's three reasons why the entry point is interesting today. One is attractive relative value to other asset classes. Secondly, fundamentals in real estate are really strong. In the early portion of recovery, we have never really seen fundamentals this strong, and that's measured by vacancies and demand. And then lastly, we think this is going to be a very durable recovery. So when you package all three of those together, investors look at stocks. Stocks are expensive relative to real estate. Real estate's down 25% relative to its peaks, pre-interest rate cycle. Equities are up 60%.
Yeah.
That's interesting to investors today.
Well, break it down for me, because obviously, I mean, real estate is a broad umbrella here. And I know your bread and butter over at DWS America is a little bit more in industrial and in multifamily residential. Is this sort of a rising tide across the board, or are there certain pockets where you're seeing a better opportunity than others?
It's a good question, and the answer is yes. It's the recovery has been bumpy. certain asset classes doing better than other asset classes. But interestingly, if you look across vacancies of all the major sectors, the four major sectors of industrial, residential, retail, and office, all of them are doing well. Even office is not too far from its historical levels of vacancy, while the other three sectors are below or at their historical levels of vacancy. So it has been uneven, but those three sectors of industrial, residential, and retail today are performing well. I believe that industrial and residential will outperform retail, which has been the best performing sector over the last 2 years. But we do think that those three are going to produce good risk-adjusted returns for investors over the next 5 years.
What about AI? You say that AI could add meaningfully to the GDP in the next few years, but how does that translate into demand for commercial real estate that goes beyond data centers?
Yes. So I'm glad you asked the question, because when we look at AI, there's some ancillary benefits of AI in the industrial sector, for example. As data centers are being built, there's a lot of material that needs to be stored in industrial buildings, and we're seeing that pick up. But I do think that going forward, as AI continues to roll through the economy, we're going to see bifurcated performance from the sectors. We think the business of goods will be less impacted than the business of people by AI. And therefore, the business of people, you think office, you think, oh boy, does office need another hit? But it's a risk for the office sector, I think.
I must ask you, given that it's in the news, what do you make of New York's statewide data center ban? I mean, we have heard multiple opinions from both sides, but what is your take on that?
So we do not have a data center in our portfolio, and we're not actually looking to grow into the sector. And the reason for it is because it's really difficult to underwrite the regulatory risk as well as the obsolescence risk that exists. So your question about bans in New York. New York was the first state to initiate a moratorium, but there's 69 local jurisdictions throughout the country that have active moratoriums against data center development. So that's that regulatory risk that exists. I think it's super hard to underwrite it today. It may mean that there is some value in the short term for the existing product, but again, that obsolescence risk is really difficult to underwrite. We think they'll probably get smaller, the technology will get better, the chips are faster, you don't need as much space, and there's also the risk of it going to space.
I am curious about what exactly is going on with regards to residential real estate, particularly when it comes to rents. And I know it really varies depending on city to city, state to state. Obviously, the city has its own unique issues when it comes to the direction of rent here. Is it going to be favorable for an investor long term in terms of rent regulations and what's going to be allowed to be made on some of these properties?
Most of the rent regulations are tailored towards older properties. And so the newer properties in these marketplaces are going to be the properties that afford investors the opportunity to pick up the income gains that we are expecting to happen, because the differential between owning and between leasing has never been wider. It's never been cheaper, to say it differently, to rent than to own. But I think you have to be careful to be able to capitalize on that gap, both from a political perspective and also from an investment perspective. And we think that the newer properties, either building them or buying newer properties that have recently been developed, are going to be those that afford investors the best returns going forward.
Have you seen any sort of overinvestment? I won't use the word overbuilding, but overinvestment, particularly in the Sun Belt and some of those areas in the South, that every investor seems to talk about as being an opportunity? Or is there just still such an undersupply of homes and apartments that you can still find something attractive to invest in?
You're right, Romain, about the supply. There was a significant amount of supply in the Sun Belt markets, but the demand has been exceeding supply, and it has been taking that supply up. You combine that with the fact that construction is down, new starts are down 2/3 from their peaks in this cycle, and that new development is never, well, in the last 15 years hasn't been lower than it is today. That makes for an environment where demand will continue to exceed the supply. And when demand exceeds supply, I talked about durability of a cycle, demand exceeding supply affords you the opportunity to grow incomes. And income growth is a very durable, investable condition that we like and exists, we think, in this market today, even in the Sun Belt where supply was overdone in the last cycle.
All right, fantastic insights. We wish we had more time, but thank you so much for stopping by and joining us. Todd Henderson, he's head of real estate for Americas at DWS.
We do want to go out to Carlisle, Pennsylvania, where the President of the United States, Donald Trump, is speaking right now at a defense symposium about further investments in the defense space. It features the president as well as two of his cabinet secretaries, Senator Dave McCormick, and several corporate CEOs, including Jamie Dimon. Let's take a listen.
Driscoll, who's really out there with that beautiful smile. With that beautiful smile, but he's actually a killer. Look at that beautiful, nice face. Everything's so happy. He's a killer. Would you believe it? Those are the best kinds, actually. Commanding General of the Army, Trevor Bredenkamp. Trevor, thank you very much. And a couple of warriors in a different way, but they are great. Scott Perry and John Joyce, congressmen, and they are fantastic, and they've been my friends for a long time. Where are you? You've been my friends for a long time. They're tough cookies, and they want what's right for the country. Thanks as well to your amazing state treasurer, Stacey Garrity, who is running for governor, and I'm telling you, this guy Shapiro is totally overrated. I watched him the other night doing a speech, and he does not have what it takes. Maybe he'll win, and he's expected to win, but I hear things about Stacey, and I'm hearing some poll numbers that are very good, but Shapiro is, he doesn't have what it takes. Now, people think that's a horrible statement to make, but that's the way politics is. That's the way it is. I tell the truth. Attorney General David Sunday. David, thank you very much. Great job, I hear. And probably the most important person in the room is Senator McCormick's wife, Dina. I mean, I know Dina. Dina worked for me for 4 years. She worked for me. I know her almost as well as David, hopefully not quite as well. But Dina has been, she's been amazing, and she's gotten a very nice position as the president of Meta, working with a very good guy. So a lot of good people, but one in particular, so good luck, and doing a fantastic job. Thank you. She was great. She worked in the administration, first term, and she was fantastic. We also have a big name, a very big name, a very brilliant name, somebody who's done, I guess, in the history, I'll make enemies when I say this, but I shouldn't because I think it's true. Jamie Dimon is maybe the greatest banker in this country in many, many decades. So, CEO of JP Morgan Chase. Thank you, Jamie. The president of General Dynamics, Danny Deep. And, you know, they make the greatest submarine in the world. They just have to make them faster. Danny, will you please make them faster? That's true with all of the munitions people, actually. Faster. We need a little more speed. We have the best quality in the world, but we need a little more speed. The president of Hanwha Defense USA, Michael Coulter. Thank you, Michael. Out there. The president and total boss of Boeing, that's Kelly Ortberg, who's a terrific guy. I think he just gave me the award for being the salesman he started of the year. I said, that's not the year. Then he said, what about the decade? Nope, much more than that. So it's the salesman in the history of Boeing. I have sold more Boeing planes, over 1,000, and nobody comes close. You know what I got for that? Nothing. I get nothing. Now, if I was in the private sector, I'd say I want a piece of the company for that, right? But, Kelly, you've done a great job. You're bringing it really back, and you're up to 44 planes now, or 44. They're producing the planes at a very rapid rate, and Kelly has done a tremendous job. President of Northrop Grumman, Kathy Wharton, made a just
And you're listening to President Donald Trump making introductions at a defense and innovation summit in Carlisle, Pennsylvania, arranged by Republican Senator David McCormick of Pennsylvania. You didn't see it there on your shot, but you did hear President Trump call out several of the corporate executives in that room. Some relatively laudatory comments for J.P. Morgan CEO Jamie Dimon, as well as Kelly Ortberg over at Boeing. Several of the Defense Department CEOs there are there as well. Also, a lot of folks from the world of finance, like Toby Rice over at EQT, John Gray over at Blackstone, and quite a few others. Yeah.
All people relevant in our corner of the world. But maybe let's pivot, Romain, and talk about our stock of the hour, and that is PayPal. You're seeing the shares of the stock there in the red, I think. It's in the green. Shares of PayPal are up higher by more than 8%, and that's on a report that Stripe and the PE company Advent International made an offer to buy the company at $60.50 a share. That's valuing it north of $53 billion. And of course, joining us live is Bloomberg TV Markets correspondent Nora Melinda, who joins us for our stock of the hour. So Nora, maybe we can kick it off with that. Why does Stripe want PayPal so bad?
Well, if you think about the fact that Stripe is really focused on merchant payments, essentially, if you think about PayPal, it has a large, essentially, attraction from consumers. So if you couple the merchant side with the consumer side, you're actually able to have a well-rounded company, especially as you think about the broader ecosystem that Stripe is trying to build out. So you are seeing PayPal as an attractive option. You're seeing analysts on Wall Street starting to question whether or not maybe some of the investors in PayPal have punished the stock a little bit too much. The stock was down about 40%, more than 40% since the start of last year. So it's starting to beg some questions as to whether or not this company is a bit more attractive than people were initially thinking.
It's such an interesting company, too, because this is basically kind of like the OG and kind of direct consumer payments, right? and then you think about all the CEOs and the executives spun out of that old PayPal mafia, including one person that we shall not name. But I'll talk about Venmo, because, I mean, there's a certain group of people out there that Venmo is kind of like, how you transact. And I just always wondered why we didn't see PayPal capitalize on that a little bit more.
And that's interesting, because you say a certain group of people tend to use Venmo.
Yeah.
It's the young folk, and that's what we are. That's what
do you use Venmo, Romain?
Do you use Venmo,
Romain? Answer the question.
Well, we see a lot of the younger consumers on Venmo, and so you see as an attractive space that Stripe is hoping to capitalize on. That's the asset that they really are hoping to get from PayPal, and PayPal not really doing enough. They were lacking on innovation. They weren't really attracting more and more consumers, more and more customers the way they should have been, and that's why you're seeing the stock really being punished, and you're seeing Stripe really trying to capitalize on that weakness.
So what are you, Isabel? You're a Venmo person, or you're a Cash App girl? What are you?
Venmo, but I have a lot of international friends, and they use Zelle.
Zelle.
So I have to have it all. And I have cash. Do you have cash? Or
I have. Old school. I just carry. I'm old man, so I walk around with like a pocket full of quarters, and pass out to all the kids.
No Apple Pay?
No, I got all that. I got Apple Pay, Zelle, and then every now and then somebody asks me to send the money, and they'll be like some app I never heard of, so I got to download. Who knows where my data's going. Nora Melinda there with our stock of the hour. Closer look at PayPal. Getting a nice boost here on some speculation that maybe, just maybe, this company could be in play for a sale. We continue to count you down to the closing bells. We're also keeping an eye on that defense summit going on in Pennsylvania with the President of the United States. We'll bring you any headlines from that as soon as we get them. You can continue watching the President there by typing Live Go on your Bloomberg terminal, or just stick it right here on the close. We're going to be back in a moment with Anastasia Amoroso over at Partners Group. This is The Close on Bloomberg. Welcome back to The Close. I'm Romain Bostic.
And I'm Isabel Lee, in for Katie Greifeld.
A mixed day on Wall Street with the Dow, the S&P, and, well, one part of the NASDAQ in the green. But you're still seeing a big drag today from a lot of the chip stocks. Some concern there. But overall, relatively muted activity.
We do have some concern, and that concern is really overshadowing the optimism we saw when we saw the softer than anticipated inflation data earlier today. Money markets are now fully pricing in a hike in December, and we're seeing short-dated treasuries outperforming the rest of the curve. The S&P, though, which I don't think we have on the board, is higher for the second straight day. So at least we have that positivity there, Romain.
Absolutely. And we get to this idea here of what the market is pricing in, whether they are rattled by geopolitics and the situation in Iran, whether they are looking through that to this drop in yields or whether they're going to put their faith in high expectations for this earnings season. Joining us here in studio, too, is Anastasia Amoroso, Chief Investment Strategist at Partners Group. Great to see you.
Good to see you, Romaine, Isabel.
Let's start off with the chip trade. And we should point, this is kind of the yo-yo, I feel like. At least if you take a look at the Philadelphia Semiconductor Index, it was like, you'd be up 3 or 4% one day on the index, down a similar amount the next. It's almost kind of like trading water to a certain extent.
Yeah.
But I do wonder if investors have sort of given up on it, or is it just the idea that the valuation just has gotten so rich that people are kind of waiting to make sure they get some confirmation that this can go on?
I don't think investors have given up on the trade, but I think the traders may have near-term given up on the trade. And look, let's just call it what it is. There's a lot of traders. There's a lot of triple levered positions. There's a lot of retail margins, for example, loans in Korea and Taiwan that fueled this trade. And to your point, you haven't seen much from this trade in the last couple of months. And so maybe that has washed out some of those traders. The other thing that's happened is if you look at earnings expectations, they've been meaningfully revised higher for the semiconductor space. And that's what really drove this just blowout quarter in the second quarter. But maybe now we've priced that in. And so you have this period of consolidation there. So that's on the one hand. On the other hand, I don't think the fundamentals for the chip trade have changed at all. In fact, I think they've actually strengthened. And you see that from the likes of ASML. Yeah. I suspect we'll probably see something positive out of Taiwan semis tomorrow. So the fundamentals are there. There's more chip demand, different types of chips. And honestly, it's not just about the chips, right? It's data centers, it's fiber, networking equipment. So all of that is still very much intact.
I guess the question is, are investors just nervous? And then so maybe these little dips, I wouldn't even necessarily call them sell-offs that we're getting, is this idea that everybody is waiting for that canary in the coal mine to finally just say, okay, here's the thing. And, maybe that comes, maybe it doesn't. But I do wonder if when we start to see these red days, that's less a function of fundamentals, less a function of even technicals, and more some of the over-leveraged positions and people just making sure they're not caught on the wrong side.
I think there's a couple of things that investors maybe are starting to get nervous about. First of all, it is still the unsettled situation in the Middle East and the fact that oil did move from 73 to 83, give or take, on Brent. And, to the extent that situation is not resolved, we have to worry about the oil supply chain bottlenecks. We have to worry about refining capacity. We may also have to worry about something like helium exports out of China. And so all of that can actually hurt the chip trade. So I think that's one part of what investors have worried about. And the other one, to your point, is, look, we may not like the latest pullback, but the SOX index is still up something like 80% year to date. So at some point, you might want to take the profits while you have them from a trader position.
You argue, indeed, that oil may be structurally higher, but that's manageable for the economy. But at what price do you think it'll be problematic for markets?
Yeah, I think anything above $100 a barrel starts to catch investors' attention. But here's what I would say. This is why I think the markets largely have been looking through this new kind of renewed uncertainty in the Middle East, is because we're finding workarounds. First of all, fortunately, we didn't draw down on a whole lot of inventories in the last 3 months. We've drawn down some strategic reserves, but we still have plenty of private market reserves. So that's one workaround. The other workaround is, of course, the East-West pipeline through Saudi Arabia and other countries talking about potentially plugging into that pipeline to reroute their own oil. We look at the situation in UAE, for example, and the talk of building the third pipeline. So I think that's what investors have to come to grips with. This is not a short-term thing. This is a long-term trend. But as long as we have those workarounds in place and we double down on them, we can circumvent the rising price of oil.
What is giving investors this continued confidence to buy risk assets? We have a Bank of America fund manager survey showing that investor sentiment is still more bullish, and it's driven by really AI, to no surprise.
I will say it's driven by a few other things. First of all, I think it is still driven by the solid consumer, the solid economy, and the fact that there's wage growth, there's jobs growth, even though it's kind of sluggish, but it's still there. And so the consumer, therefore, keeps on spending. And by the way, retail sales came in fairly strong. And also, if you look at the real-time credit card spending data, we're looking at an acceleration of pace over the last few weeks. So that's positive. perspective, the other thing, of course, the AI capex, but also the big part of the conversation today with Fed Chair Warsh was about AI capex. And not only that, but it was about capex in general and the surge that we're seeing in capital expenditures. So that's a lot to be excited about. And then you look at the earnings season and just sort of the rock star results that some of the banks are delivering. So there's a lot of momentum in the economy.
A lot of momentum, and obviously the AI, I mean, we can talk about these short-term moves, but obviously there's a long-term structural story that most investors have tried to latch onto. There's another story that's been afoot, and that involves defense spending and just the changing nature of what a military and defense looks like. The president now in Pennsylvania at a summit that is addressing this as well. And we've seen a lot of investors gravitate to defense stocks, but not just, the big ones like your Northrops and Boeings, but drone makers and a lot of other sort of, I guess, newfangled players in this space.
Yeah, that's right. It is such an important point. It is such an important theme, and one that we've absolutely been looking very hard into. And first of all, we used to be in this kind of, bipolar world, a unipolar world at one point, and now we're in this multipolar world, and that means that all parts of the globe have to spend on defense. And whether it's the United States, whether it's Europe, whether it's Asia, we're seeing defense spending going up globally. And also the nuance there is, where are those dollars or yen or what have you are being routed? And they're being routed into the local supply chains. That's likely to be the case in the United States. It is certainly the case in Europe. So from our perspective, we want to look to some of the local suppliers and also not necessarily look at the defense primes, but look at perhaps the parts manufacturers, the equipment manufacturers, who may still produce equipment for civilian purposes, but they also will benefit from the build out of defense. I will say private markets activity in defense has certainly picked up. Valuations have certainly picked up. But if you look at aerospace and defense as kind of the share of overall private markets activity, it is still quite small. So I wouldn't call this a stretched trade just yet.
All right, Anastasia, always a pleasure. Anastasia Amoroso, Chief Investment Strategist over at Partners Group. And we should point out, speaking of defense, we were keeping an eye on oil prices. When we started the show just about 57 minutes ago, basically flat on the day. We're now seeing both Brent and WTI up more than 1% as we continue to get headlines with regards to another round of bombings going on in Iran. Our global simulcast, it starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Isabel Lee. Katie Greifeld is off on the day. We're taking you through to that closing bell at the global simulcast. Carol Massar and Tim Stenovic join us now. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube here for our hydration break as we take you to the closing bell. Carol.
No joke, man. It's hot out there, and then there's the smoke and the air conditions. It's kind of a meh.
Right over our head, Tim.
Sometimes I just choose to ignore you. Okay.
I thought it was good. I thought it was good.
Thank you, Tim.
I'm a World Cup fan. What can I say?
Oh, God. Isabel, these bros, man, sticking together.
Bros,
That's what happens.
Yeah, you know me and Tim, bros.
Yeah. We're just in the dressing room talking sports all day.
Should I wear the blue suit or the gray? Which tie do you like?
No, I have Romaine tie my ties for me.
Do you really?
Oh.
Romaine,
I don't wear ties.
You don't wear ties?
I don't.
It's very cute. Yeah.
Is it my turn?
Yeah.
I do want to get serious a little bit because there's still the question about what happens and what is happening in the Middle East. The Wall Street Journal out with this story just in the last 25 minutes about the president reporting that the president is leaning toward expanding U.S. military operations in Iran. Expanded U.S. efforts in Iran could include ground forces, according to the Wall Street Journal. There's talk about Karg Island, though the president has not made a final choice on the next steps in Iran. So this is still part of the market backdrop and certainly the energy backdrop too, Romaine.
Yeah, and we were just talking about an hour ago when we started our show, the close, oil prices, oil futures are relatively flat on the day. Now, both WTI and Brent up about 1%. WTI back above $80 a barrel. Brent crude back above 85. Meanwhile, we get the closing bells in New York for equity prices, and we have a mixed bag here. Green across the screen for most of the major indices, with a couple of notable exceptions. The Dow Jones Industrial Average higher by 150 points, or 0.3%. The S&P higher by 29 points, or 0.4%. The Russell 2000 unchanged on the day. But I want you to take a look. The Nasdaq Composite up about 0.6% on the day. We don't have it on the screen there, but the Nasdaq 100 is in the red, Carol. It's down about 0.3%. And that's largely because of, once again, a bit of a sell-off in the chip space.
Yeah, right. It just the swinging when it comes to those semi names continues. And again, actually, we got some earnings remain.
Yeah, let's get right to it. We heard from Delta Airlines last Friday. It was a relatively bullish earnings report. United Airlines now crossing the wire for the second quarter. The company says that adjusted EPS did beat $1.99 a share. The street, on average, was looking for $1.85. Revenue, operating revenue, just above analyst estimates at about $17.7 billion. Available seat per miles did beat, as did some of its CapEx numbers. Revenue per passenger miles relatively in line with estimates at about $72.7 billion. And here's the guidance. The company, Carol and Tim, they say, and Isabel, say that adjusted EPS for the full year will go up. It will be $9 to $11 per share. It had previously saw a range of $7 to $11 per share. So basically raising the low end of that estimate from $7 to $9 per share. The street on average looking for about $10.51.
Yeah, I'm looking at oil, like the oil commentary from Scott Currie in this, because what United says is based on oil prices as of yesterday. United expects nearly $6 billion in added fuel expense for full year 2026 compared to the expectation at the start of the year. In the second quarter, fuel expense was up $2.3 billion, or 84% year over year. The company recovered approximately half of this increase. In the third quarter, the company expects to recover about 80 to 90% of the increase, and 100% by the fourth quarter. Yields up 12% during the quarter, so strong demand. But this business is so sensitive to fluctuations in oil and jet fuel prices that you see a lot of movement one way or the other when there are big moves in the market.
Yeah, and kind of telling that they were willing to narrow their range for EPS guidance, but not actually raise the high end of that here. So that might actually say a lot more than what they actually said.
Yeah, also just breaking it down, premium revenue up 16% compared to the second quarter of 2025. Revenue from basic economy up 11%. Loyalty revenue up 11%. Cargo revenue up 23%. They say close-in demand remained robust, with contracted business revenue up 27% in the quarter. The economy cabin continues to recover, with unit revenue up 12%, marking 2 consecutive quarters of positive growth, but still looking at the stock down about 2.8% here in the after hours. Year to date, though, the stock is up about 8%. Isabel.
Let's take a look at the IMAP now. So we saw kind of a split screen with the S&P ending higher and the Nasdaq ending lower. And when you look at the IMAP, it's looking mixed. The biggest gainers, tech higher by 0.3%. Financials, of course, after the blockbuster earnings season when 6 out of 6 really saw beats, higher by 0.7%. Down energy, you're seeing it lower by 0.5%, and materials lower also by 0.2%.
I do want to go back to United Airlines and to Starlink, because as these airlines are increasingly investing in connectivity for their customers, United is certainly one to watch because it does have this deal with Starlink. If you've flown on a United Express flight in recent months, you've experienced Starlink. These are the smaller airplanes, the regional jets, Romain. I don't know if you've done this maybe. The connectivity, it's like faster than when you're at home or on the ground. I flew on one of these planes just a couple days ago. The company's saying that customer satisfaction scores on flights with Starlink are twice as high as on other United flights. And wondering now, and it's free. It's free for United Mileage Plus customers. It's a big investment that United is making, but it's a way for them to differentiate from other airlines. And now they're saying they're going to get it to their entire fleet in the next couple of years.
And this has been a big question that I've asked a lot of the airline analysts that we have on, is what is the differentiation, at least between the big three, United, Delta, and American here in the U.S. And it really is about the in-cabin experiences. It's funny you mentioned, that United, of course, provides that for free. We should point out one of their competitors doesn't, unless you're, part of their rewards program. So there is a disparity there. And I think you're starting to see a lot of these companies pay a lot closer attention to what they're offering in there to try to justify, let's just face it, some of the elevated prices for those seats.
I'm smiling because I have no brand loyalty. I just go to Google and then the cheapest flights, that's what I book. So my points and my reward system, they're all over the place. I have almost zero, but I guess that's the price I pay for being disloyal.
All right, guys. JB Hunt, a trucking company, out with their earnings. Let's go through the numbers. Second quarter EPS, that's a beat, $1.91 a share. The estimate on the street was for $1.74. Second quarter revenue also coming in better than forecast by the street, $3.5 billion. The street estimate was for $3.25 billion. Second quarter intermodal revenue, that too is a little bit higher, $1.75 billion versus an estimate of $1.6 billion. And second quarter dedicated revenue, $921 million. Estimate on the street was $897.3. Stock is up 2.2%. You know, we love to see the transportation sector, what is going on. Commentary is also always so important because it's a great read on the economy.
Well, speaking of commentary, Shelley Simpson, the president and CEO of JB Hunt, talking about cost discipline in a, quote, dynamic environment. She said, Shelley Simpson, president and CEO, also saying that market conditions are continuing to evolve. The company remains focused on creating long-term value for our shareholders, delivering valuable solutions to our customers while maintaining discipline around return on capital. So discipline, cost discipline, a dynamic environment, market conditions evolving.
And this gets to the idea, too, that we had this sort of a big trucking recession, and then that kind of shook out a lot of players, and that benefited the folks, of course, who did survive. And, of course, there's an economic story that underpins it all as well, Tim and Carol, and this idea here that if the consumer is still spending, but also the idea that a lot of these trucking companies, they've been making a lot of money, not on the consumer side, but on the industrial side. There's been a huge ton of activity with regards to manufacturing that has to be shipped around the country, and JB Hunt and some of its peers have been big beneficiaries of that.
And now you're looking at shares of JB Hunt climbing 2% after they top estimates in post-market. So it's really going to be interesting to hear what their commentary will be, because to Carol's point, it's going to be in the weeds of the economy. And I feel like the banks, their earnings, they were great. They were blockbuster, rock star, as Anastasia Amoroso earlier said. But this is a different sector of the economy, and it's still interesting to hear what they will be saying.
Yeah, it's interesting. And as you said, I mean, this stock's on fire this year. It's up about, I think, 46% year to date. And again, getting another bump to the upside. But, you know, things like airlines, too, I just keep thinking about how they are increasingly, it feels like, catering to a wealthier customer and offering, you know, more choices, if you will, for a wealthier passenger. And so great reads on the economy, but maybe you know, increasingly a sector of our economy.
Well, yeah, and you saw that, right? I mean, it's not, you don't think it. I mean, Ed Bastian, that interview he gave to Lisa Abramowitz a couple of days ago, he kind of made it clear. I mean, that's where they're moving, right? It's expand business class, expand first class, and try to milk as much as you can out of those folks.
Yeah, exactly, exactly. All right, guys, that is a wrap. Our cross-platform, some earnings too, as earnings season is slowly getting underway here. That is a wrap. Our cross-platform on radio, TV, YouTube, Bloomberg Originals. Isabella Romaine continuing on the close on TV. Tim and I back here on Bloomberg Business Week Daily on Bloomberg Radio. Folks, we will see you again, same time, same place tomorrow.
And our coverage continues here on Bloomberg Television. JB Hunt shares in the green, United shares in the red. We're going to break down what exactly United Airlines had to say with Steve and Trent when we come back after the break, right here on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Romaine Bostick. Stocks did close, and for the most part, in the green. Fractional gains for the S&P, the Dow, and the NASDAQ composite. The NASDAQ 100, though, still weighed down to a certain extent by a sell-off in chips. You did see a big drop in yields on the day, and that helped give a boost to the real estate sector as well as to big banks. But you flip up the board, and you get a sense of the disparities of what's been going on out there. Take a look at shares of Dell. They were under pressure along with the broader AI space for most of the day. At one point on an intraday basis, Dell was suffering its worst drop since April of last year. SpaceX shares down fractionally on the day, 0.6%. At one point, it did trade below its $135 offering price from last month, though did manage to close just before that. But two big bright spots out there. BlackRock up about 7% on the day, one of its best days in about a year, as the world's largest asset manager posted yet another record quarter. And Royal Caribbean and most of the travel stocks also higher on the day. That was largely a function of the fade that we saw earlier in the session when it comes to oil prices. Of course, some of that is changing here in the after-hours trade. We did just get earnings just a few moments ago out of United Airlines. In the after-hours trade, those shares down about 4%. The company did beat on most of its key metrics, but the guidance it gave, it basically narrowed its full-year guidance for the year, pretty much upping the bottom end of its range to $7 a share, but keeping the top end of that range at $11. Joining us right now, talk a little bit more about this, is Stephen Trent. He's the president of aviation and aerospace research firm SDT Capital Advisors. All right, Stephen, great to have you here. And I just misspoke there. I should point out the low end of that range went from 7 to 9. The top end stays at 11. But when we talk about profitability for this company, is this still a story about where fuel prices go?
And thank you for having me on. I think fuel prices are definitely part of the game, and that's playing a role in the short-term price action we're seeing in the aftermarket, for example. So I think, for instance, when you look at what this carrier is going to do over the second half of the year, I think the interplay between what happens with fuel and where these guys go in terms of unit revenue, I think that's exactly what the street should be watching from a fundamental perspective.
I mean, passenger revenue in the most recent quarter, it was up 16%. I mean, it's relatively in line with estimates, but the idea is that and you talk about also a capacity, which they're also saying in the press release that just moved that they actually plan to reduce the capacity to a certain extent going forward. So they seem to be making the right choices with regards to trying to keep not only folks on the plane, but also to make sure that they project their margins. Do you think they have enough room to be able to thread that needle?
I do think they do. And when one looks at the network airlines versus the discount airlines, when we look at the amount of muscle the network airlines have and what that has meant in terms of their being able to de-risk their earnings streams post-pandemic, they have a lot of tools at their disposal, that the discount airlines don't have. So premium cabin, co-branded card, loyalty, and you look at what that has meant, for example, United Airlines, and I'm not counting today's print because I haven't run the numbers yet, but United Airlines' latest 12 months cash flow from ops is up 361% versus 2021. Delta has more than doubled. American Airlines, it's up 591% versus that period. Southwest in nominal terms is up a mere 3%. Frontier is down. JetBlue's down worse. So I think this de-risking strategy that you've seen with the network airlines is a big deal, and it's tangible. And we saw that in United's results this afternoon. We saw that in United results. We saw decent results last week out of Delta. How much are Delta and United benefiting from some of the struggles at some of the other names you mentioned, whether it's the loss of a couple of those discount carriers? American Airlines is kind of a mixed bag, and we still have to wait to hear how they performed in the most recent quarter. But does that help them, meaning other folks' struggles? So I don't think the Spirit Airlines' demise is that big a deal for a Delta or United. They do have basic economy, which you can argue in the domestic market perhaps marginally benefited from it. But that's a small piece of the pie in terms of the cash flow stream these two businesses have. I would honestly say co-branded card remuneration, what's happening in the front cabin, the premium side of the fence, those are really the big drivers. How much room do they have to go with that? I mean, Delta has been, or I should say Delta has been pretty aggressive about expanding out its premium offerings, whether it's in first and business class or that premium economy. United has also done a lot with regards to its quote-unquote premium economy as well. Is that just chopping up the plane more, or is it just offering different types of services with what they already have? Yeah, more of the latter. So it's unbundling from front to rear cabin. You even have some of the airlines, United, for example, maybe experimenting with this business class product that is slightly different from the previous business class products or the other business class products these carriers have. So I do think there's a lot of room. And in terms of demand, when we sort of think macro things, this whole K-shaped economy, the wealthy consumer is still, or shall I say, the relatively wealthy consumer is still driving the demand. And as long as that holds up and that spending holds up, I think the big three can continue down this path. And you have confidence that that will hold up? So putting on my economist hat, I would say, as an aviation analyst, so long as the equity market continues to do reasonably well, that segment of society is going to continue to spend. All right.
Stephen, really great to have you here in Studio 2. A quick breakdown of those earnings out of United Airlines. Stephen Trent, president of SDT Capital Advisors. Now, when we come back, we're going to talk about the divergences that we continue to see in the market. They're everywhere, at least according to our next guest, Katherine Bordlemay of Goldman Sachs Asset Management. She joins us after the break, right here on Bloomberg.
You do, frankly, have better valuations in the communication services sector, but when we looked at tech, we've actually seen it's improved basically back to neutral, just given some of the carnage that we've seen. And you have seen a bit of an unwind in semi-valuations, which had gotten pretty expensive. They're not super cheap yet. They may still have more to go. I want to be clear about that. But we have done enough improvement there to allow the sector, kind of froth to come out.
Lori Calvasino over at RBC. She joined us yesterday about her thoughts on tech valuations heading into this earnings season. And it is an earnings season with some high expectations. Here to talk a little bit more about that is Katherine Bordlemay, co-head of America's Client Portfolio Management at Goldman Sachs Asset Management. Great to see you.
Good to see you.
Well, let's start off with earnings, but specifically on the tech side, because expectations are sky high. But so far, we know a lot of these companies have the ability to meet those expectations. We got a little taste of that overseas last night with ASML, the big chip equipment supplier. We're going to get that later tonight with TSMC, also overseas. Here in the U.S., when we start to hear from some of these tech names, whether it's on the chip side or even beyond that, do you think they are going to be able to meet that high bar?
Yeah, we think so. Look, the theme of AI dominance, it's going to continue. But what I think is really critical to remember is that as AI evolves, so will the winners. So we need to be aware of the broadening. And right now, we're really focused on the bottlenecks. So I think there's kind of two ways I think of it. First of all is the money and how much more durability do we have in the CapEx spend. The demand is relentless. And just one data point that I think is interesting, if you looked at pre-ChatGPT, we saw about 300 million of annual hyperscaler spend. And this year we're expecting 800 billion, and we're on track to 3 trillion.
Wow.
So there's a lot more to go. So it's about the dollars and where they're going because we want to follow the earnings. So we're really focused on the bottlenecks of the supply chain, and they continue to evolve.
So explain that. Where are the bottlenecks from an investment perspective?
So, I mean, memory is the obvious one. I think another thing we're spending a lot of time on as models go from training to inference, the ratio of what you need to GPUs, CPUs changes. So we're going to need a lot more CPUs. That's another area. So it's CPUs, it's networking, it's optics, it's things that haven't even been innovated yet.
With regards to some of the beneficiaries of that money, because obviously, every CapEx dollar spent is going to someone here. We did see an interesting rally in a lot of smaller, kind of mid-size and smaller tech names. And we've talked a lot on the show about how the Russell 2000 has kind of been the stealth relative outperformer, certainly keeping pace with the broader market. Is that the AI story at play, or is there something else going on there?
Yeah, there is some, but it's not all AI. And by the way, small caps with our client conversations tend to be a very under-owned and unloved asset class, which is why I love it. The Russell 2000 is on track to have its best year of outperformance versus large caps since 2003.
Wow.
So if you think about the earnings separation, we talked about divergence. You've seen large cap here, small cap here, and it started to inflect in 2025. So if we continue to see that convergence in earnings, that's pretty interesting. So you get the AI, but it's more the adjacent picks and shovels. Plus, you get other more independent themes like biotech.
Outside of AI, there are some expectations that we're going to see a broadening out of sort of the earnings boom. That is not just going to be the big tech companies, the AI-related companies. Do you have confidence that maybe we'll see that, whether it's from consumer discretionary or healthcare or whoever else? I mean, we saw it from the big banks already.
Yeah. So the broadening out has been happening. And actually, I remember when we had the opportunity to speak before, we talked about broadening beyond the mega tech, and that's exactly what's happening. So you're just going to continue to see more of that. I think another area we're watching closely is actually emerging markets. It's been very concentrated, but as we move toward the back half and beyond, we think it's going to continue to broaden, whether it's AI beneficiaries and other types.
Well, I have to ask you about it. So when we talk about emerging markets, because I mean, the joke has always been that, if you take emerging market index and you back out, the two big Korean companies that are still in a lot of those indexes, the story is a little bit less. Is there an emerging market story that isn't dominated by Samsung and SK Hynix?
Absolutely.
Yeah.
So even if we remove Taiwan
Yeah.
and let's remove Korea, we're still going to get more than 20% earnings growth this year, which will probably more than the U.S. So there's a lot of growth. And I'll pick on Korea because everyone talks about how there's only like 2 or 3 stocks there.
Why is that an emerging market still? But anyway.
But exactly. So, well, of course, we have AI. Korea's dominant in shipbuilding. They sell a lot of cars. They do a lot with pharmaceuticals. My personal favorite is, of course, culture, K-pop, K-beauty, the World Cup. We're all going to tune in. We're going to watch K-pop perform next to, Madonna and Justin Bieber. So we know that they made it. So there's a lot of good things going on in addition to AI.
Yeah. By the way, for our viewers, don't change your channel. England's up 1-0 versus Argentina.
It's way better.
The big event, of course, on Sunday here in New York. You're referring, of course, to the big halftime show that they're planning. But staying on the EM topic, though, I know the trade was popular coming into this year. There's been still a lot of concerns about the impact of geopolitics, the elevated energy prices, not just on oil, but on a lot of the refined products. Does that become a concern? And what is the interplay with regards to the dollar and currencies overall? Can that trade keep going in spite of all that going on?
Yeah, so there's clearly risks, and the result of that, whether it's emerging markets or really anywhere, is we're seeing record level divergence and dispersion. So I think that's why you need to be quite selective. And actually what you've seen over the year-to-date period is the vast majority of active managers are beating the index after fees. And if you can get a top quartile one, they're beating by almost 10%. So they're really exploiting and stepping in when we see these aggressive dislocations. So if you get the right team, you can actually navigate this with success. And to your last question on the currency, over, let's call it 3-5 years and beyond, earnings have driven 80% of your earnings growth. So currency, sure, in the near term, it's going to bump you around. But if you keep your eye on the ball, which is earnings, it'll get you to the right place.
With regards to the rate situation, and I know rates have been relatively volatile here in the U.S. as everyone's trying to figure out where the Fed goes next. But when you look at the macroeconomic backdrop and, whatever the Fed has communicated so far, do you anticipate that there will be maybe some degree of stability in rates to the point that it will be supportive of equity valuations? Yeah, so, we may be in a higher for longer era. We have to watch inflation. We got some pretty encouraging data this week, but it's definitely something that we're going to need to watch. And likewise, if we do go into a kind of worst case scenario of higher inflation, again, this is going to change the setup, this is going to change the playbook, and we'll just need to embrace companies that could actually be winners in that environment. All right, Katherine, great to have you. Katherine Bordlemay there of Goldman Sachs Asset Management. As we continue here on the close, we are going to talk a little bit more about the World Cup because it is a busy week in sports, particularly here in New York. You got the ESPYs tonight, you got Fanatics Fest coming up in a couple of days, and of course that big World Cup final out in the Meadowlands, not MetLife Stadium anymore. We're going to talk to Currie Salter. He's the CEO of Entertainment for Authentic Brands, and he's at the center of a lot of what's going on over the next few days. That conversation is coming up after the break, right here on Bloomberg. Well, I'm told somewhere the World Cup semifinals are going on. England versus Argentina, that is underway. England up 1-0 right now, if you care. But a lot of anticipation is, of course, building for Sunday's final right here in the New York, New Jersey area. The tournament capping off a packed week of sports and live events out here, including the ESPY Awards tonight, Fanatics Fest kicking off tomorrow down at the Javits Center. And right here in Studio 2 at Bloomberg World Headquarters is Currie Salter. He's the CEO of Entertainment for Authentic Brands to talk a little bit more about the business behind the live event. Boom. Great to have you here, man.
Thank you for having me. I appreciate it.
Let's start off with the World Cup. I mean, you've got an event down at Cipriani. Is it just like a concert? Is it just a fan watch party? You got 50 Cent, Diplo, a few other people down there. What's that all about?
It's going to be amazing. So obviously, what we try and do is this is like one of the biggest sporting events in the world. Is the biggest sporting events probably of the world. And so what we do is with our brand Sports Illustrated is we try to capture around that and build an incredible live event that people can come and experience and activate our brand around that moment. So this weekend we're going to do that, and it's going to be pretty amazing. Like you said, we have some great talent that'll be there.
And we should point out for our viewers, I mean, Authentic Brands, you have a collection of brands, including Sports Illustrated, Champion, Reebok, quite a few others. You work with Shaquille O'Neal, Kevin Hart, David Beckham, and quite a few others. So it's pretty sprawling. And I mean, it's not just selling products. I mean, you are creating content, entertainment, IP, etc. I am curious about when you're working with athletes, so take a Shaq, or maybe let's do a David Beckham since we're talking World Cup here. I mean, what is the strategy that you take with someone like that? I would assume that someone like David Beckham just kind of sells himself, right?
Yeah, I mean, listen, David's amazing. Obviously been off the pitch for a number of years now, but still incredibly relevant. And so what we do and what we did with David, about 5 years ago, we partnered with David in a joint venture. And our goal is to build David Beckham as a brand. So he's more than just a celebrity. He's more than just an athlete. He's more than just an icon. And so what we try and do is build a business around him. And so he is very global in nature. And so we're going to make products that make very authentic sense for him. And then we're also going to build businesses around David.
I'm curious as to how you manage that versus some of the intellectual property you hold for artists that are long gone, like Elvis, like Muhammad Ali. Is there a difference in approach that you take with that? I mean, obviously, Muhammad Ali, iconic. I think most people know him, but also somebody who's not here to sort of promote himself the way a David Beckham or a Shaq would be.
Yeah, of course. Yeah. So, I mean, with David, obviously, again, talking about World Cup, David's at the game right now, watching it in Atlanta, cheering his home country on, and he's on television. You're going to see him. Muhammad Ali, you're not going to see. So what we have to do is we have to bring Muhammad Ali back, make him incredibly relevant. So we're doing that with the greatest right now with Amazon. We partner with Michael B. Jordan and Jay-Z, and we're putting on kind of the cradle of the grave about Muhammad Ali, and that'll bring him back to the zeitgeist. So once we do that, that helps bring him back, and then we are able to sell products because of that. Content drives commerce.
I grew up in Hyde Park, Chicago, and he had a house right around the corner from us. And every time he was in town, we were little kids. Of course, we would all run up to him, and he was always just, hand out candy, dollar bills, whatever. Absolutely a wonderful time of my childhood with that. When we talk about sort of what your presence is at these events. I mean, we mentioned Fanatics Fest, and I know Shaquille O'Neal, who we've had on the program, and we had your father on when we were out in LA. He's got a new series called Dunk Man coming up. And that actually debuts, what?
Yeah, so that'll
this week or next week?
So we're going to do an exhibition. We brought 4 of our 24 dunkers that are going to be at Fanatics Fest tomorrow. So we're going to do a press conference with the dunkers, and then we're actually going to break a world record tomorrow. There will be a Dunkman court, and Shaquille, who is the commissioner of the league, will be breaking. He will not be actually breaking the record. One of the dunkers will be, but it's going to be amazing. We then officially start the league on Tuesday, July 21st, and it'll be 5 different league debuts, and it's going to be pretty amazing. It's going to shock the world what we're pulling off.
When you're trying to come up with ideas, though, I mean, where does it start? I mean, do you first just pick the brain of Shaq or David Beckham or whoever, or are you all just sitting kind of in a conference room and then saying, okay, let's just throw something at the wall and see what works?
No. So when we're talking about our living legends, Shaquille, David, Kevin Hart. That is all with them. Everything we do, they have their pulse on. So it's completely 100% Shaquille's idea to come up with a Dunkman League. And he's then got a great team behind him that executes with him alongside. But he is involved in choosing the dunkers, deciding on if we're going to do Dunk of the Night or not. All the things that we're implementing are with his blessing.
Before I let you go, I have to ask you about Care Bears.
Yeah, absolutely.
You bought the intellectual property of Care Bears. Why? What's happening? That seems like a departure from some of the other brands you're affiliated.
So you'll hear some of us say that Disney's the largest licensing company in the world, and Authentic happens to be number 2, and they are involved in character and animation. We have no children's IP inside of our portfolio, so we've always been looking for IP to enter into that space. I have 3 kids myself, and so I always try and get into things that my kids love because, again, it's recession-proof. And so Care Bears was an asset that was put up for sale, and we immediately looked at it and said, this needs to be in our portfolio. We can excel this business. We can grow it. And, again, it's a content-driven business that we are going to turn into lots of commerce.
All right. Great to have you here, Currie.
Thank you so much. I appreciate it.
Currie Salter, he's the CEO of Entertainment for Authentic Brands Group. As we continue our show here on The Close, a quick check of the after-hours trade. We are waiting for that conference call from United Airlines to start in just a moment. The shares have been under pressure since the earnings release just a little while ago. A beat on most key metrics for the most recent quarter, but the guidance going forward, narrowing of the guidance, but only on the low end, keeping the top end capped. There are some concerns about fuel prices. Meanwhile, the transportation renaissance continues afoot. J.B. Hunt, a blowout quarter, and some relatively aggressive comments about what the future holds. So shares up 8% in the after-hours trade. This is Bloomberg.
The great wealth transfer, the generational wealth transfer that you referred, is very, very evident in our business. You know, we see it in the number of single owner collections that are coming to market that are well over 100, $200, $300 million. These are collections that nothing of this size had ever even come to market, less than 10 years ago, really.
Yeah. Sotheby's CEO Charles Stewart speaking yesterday here on the program about record first half for the auction house. Well, Christie's, no slouch itself, also a record half. It's also saying that 47% of new clients this year are millennials or Gen Z. Joining us right now is the CEO of Christie's, Bonnie Brennan. Great to see you.
Good to see you as well.
I do want to start off with the first half numbers. $3.5 billion. You can correct me if I'm wrong. That's up 71%. That's your best in 5 years. Yes. Give me a sense here as to sort of what exactly drove that.
I think, the best news for the market is we saw strength at all levels, in all regions, across all categories. And I really mean that. The numbers show that. Collections, pieces with great stories, those still really drive great interest. But it's not just fine art, it's pop culture. We had a great sale, $105 million for Jim Irsay's collection of pop memorabilia. Somebody paid $15 million for a guitar. Over $11 million for Jerry Garcia's Tiger guitar. So we're seeing that younger audience, that 47% of our new buyers who are younger, really looking at diverse categories.
Well, let's talk about the dichotomy between some of the more collectibles, I guess the newer type of fine art, if you will, and some of the more traditional. You also had the SI Newhouse collection, which I think was kind of the star of the show for the first half and helping to drive the numbers. Is there a generational gap there in terms of the type of people that would be attracted to that sale relative to what Jim Irsay had put out there with his collectibles?
Yeah, I think at the masterpiece level, we're always going to see competition from more established buyers. We sold all three of the top prices in the first half were sold at Christie's, 2 of them over $100 million. So at those levels, you're going to get a pretty rarefied air and audience. But we're seeing that young buyer base buying not only in luxury, but also in 20th and 21st century art. So they are looking at artists. I would say they're looking most at artists of their own generation.
Well, I mean, let me talk about the Paul Allen sale, because this one kind of jumped out at me, and I think we had you on before talking a little bit about it. And I was looking at some of the numbers on these, and I mean, obviously, you're not going to tell me who the buyers are, but this was back in May. You had $1.1 billion, is that correct, on that sale?
Paul Allen was in 22, and it sold for $1.6 billion.
$1.6 billion. Yep. And then Newhouse was?
Newhouse was 630. It was the highest selling collection.
That was the highest
of the spring,
selling.
But it's part 4, so it's over $1 billion for the collective Newhouse total. We've had several incarnations, this one being the biggest chapter of that sale.
Yeah.
He was such a really sophisticated collector of masterpieces. And so we've been lucky enough to sell, we sold a Koons rabbit several years ago.
Yeah.
This season it was about Pollock and about Brancusi and Picasso.
Do people come to those auctions looking for the art or the provenance of who owned it?
I think both.
Yeah.
People, what we find is regardless of market conditions, people want great quality works with a good story. And there's no better example of a sophisticated, dedicated, passionate collector than SI Newhouse.
I want you to tell me the story. Speaking of a good story, Michelangelo's The Foot. So apparently, I'm told that some just random person was sitting on a Michelangelo that they inherited from their mother or grandmother, didn't quite know what it was, submitted it to Christie's to take a look at, and then found out that they were effectively sitting on something rare and incredibly valuable.
Absolutely.
Yeah.
That was a great testament to the expertise and the scholarship of my colleagues in London, our Old Master Drawings department, who recognized immediately some of the characteristics that jumped out as a Da Vinci. And so to be able to bring that to market and to achieve such an extraordinary price, $27 million for a work on paper, was a great story. You know, it makes everybody want to go up and look in their attic and think about maybe something they inherited or bought, and maybe they have a treasure.
What gets you most excited when we start to talk about, you know, any upcoming auctions or just the type of things that come across your desk? Is there something that kind of gets you more excited than others?
I think all the things that can bring new audiences to Christie's. You know, that is what we have to do and what gets me excited. When we see those numbers, about 47% of our new buyers are young people. To me, that says we're doing something right. We're bringing things to market that they're interested in. We're going to launch a FIFA, so World Cup themed sale, online sale, starting on the 22nd. That's a good example of a perfect blend of philanthropy and also pop culture, and something that, look at the way the world is celebrating World Cup right now, and we're excited to be a part of that.
Well, I mean, your memorabilia was up like pretty significantly, right? It was like, you know, 300% or something like that. Does that become the future of Christie's, or is there going to be just this balance between, you know, the more traditional, what we would traditionally think of as auction items?
I think it's one chapter of many. I'm encouraged too by the number of younger and newer buyers who are looking at the old masters, our old master paintings, things, you know, Dutch still life paintings. We put one in our Hong Kong sale room in March, and we had 11 bidders, 7 of whom were new to us. So I think that we hope to get them in through these pop culture or luxury and show them great classic works of art, whether that's 20th century masters or 17th century.
With regards to the demographics, geographic demographics, are you seeing more demand in coming from certain parts of the world?
In this first half, the market's been dominated by America, 54%. By the Americans, but that's largely.
Were you surprised by that?
I'm surprised. Yeah. It's usually around 50. I think it's really about what we offered in the first half, and it was material that really spoke to an American audience. But our numbers in Europe were up, which I think is great. I think we've seen great strength in London and in Paris this year. In March in our London sale room, April in Paris. So I think there's so much opportunity and growth across the European continent and in the UK. So I think that's one to watch for the back half of the year.
I mean, what do you want Christie's to be long term? I mean, you know, you've had a chance to settle into this job. You've had a couple of good rounds of sales. I mean, where does this company evolve, and what does it turn into?
I think being relevant to the next generation, we have to give them what they want and how they want it. 85% of the bids in this first half were placed online using our online tools. That's up from 80 last year. But we also need to keep that new audience. We have 30% new buyers last year, 29 in the first half this year. So I need to keep bringing in new people, and I need to do that in a way that they want to engage with us and show them things that excite them.
What about the talent that you have or that you try to bring in that can make sure that you have the right people to assess what's worthy, but also obviously to go out there and find, you know, potential buyers and sellers for that matter as well. Have you started to see maybe a shift in what you're looking for out of those types of people?
You know, we are a company 260 years old this year. It's our birthday. We're grounded in expertise and scholarship. It's a relationship business based on trust. So yes, we need to build a deep bench of those people. People come to Christie's expecting that we know that we're going to help them figure out if that Da Vinci in their closet is a Da Vinci. So I need to make sure we have the very best. Our whole business is about the best objects, the best collections, and also the best talent.
All right, I'm going to go scrounge through my closet and see if I have something there. Bonnie, always great to have you.
Thank you so much.
Bonnie Brennan there, the CEO over at Christie's. All right, when we come back, we're going to talk about frozen yogurt. It's back. It's actually a big business. Bloomberg has actually crunched the numbers, and we're going to talk to the founder of, well, if you've ever been down there near Union Square, you're going to hear of Mimi's Frozen Yogurt. We're going to talk to Amber Linz, the CEO and founder of that company, when we come back after. You know, I was just down in that line yesterday. That's coming up next here on Bloomberg. Frozen yogurt is getting a second act. The names you grew up with, like Pinkberry, Yogurtland, or for us old folks like TCBY, there's a new generation out there, including Mimi's Birdies, fueling a Fro-Yo revival with lines out the door. And I wasn't joking. I was down at Mimi's in University Place just last night. Pleased to say that the founder and CEO of Mimi's joins us here in Studio 2, Amber Linz. Great to see you here.
Great to see you.
This has been like the sensation. Anybody who's walked past your location down there, it always seems to be a line down there. Great location because you're right by a university there, so you get a lot of the younger folks who are going for this. But the demand for this, I mean, really goes beyond just Mimi's. We've seen a real revival of interest in frozen yogurt, and the numbers that Bloomberg has crunched really backs it up. I think 26% growth just industry-wide overall. Give me a sense here of what you were trying to go for, because what you're doing, it's a lot of different ingredients, more natural ingredients, a lot more creative toppings and things like that. What was your general mindset of what you were trying to establish?
You know, it's funny because when I first moved here, which was 2 years ago from Australia, I looked around and I think I saw what everyone sees now with these crazy lines outside, you know, the photo booth or outside clothing shops, whatever it was. And I was fascinated with the concept of that. You know, what are they doing and waiting in line? And I remember going to this viral photo booth in Lower East Side at the time, and I would ask, you know, the young people in the line, sort of, what are you waiting for? And they turned to me and they sort of were just like, oh, I don't know, I saw it on TikTok. And it made me realize they were looking for an activity, an experience, something to do, somewhere to go, somewhere to hang, something to talk about, something to laugh at. You know, it was less about the photo booth or less about, in our case, technically the frozen yogurt. It's the third space. It's the concept of going somewhere with friends, having a laugh, catching up. That is what I wanted to create more than anything.
Fun fact, I get my hair cut across from that photo booth. And I remember when I first started, people saying, I kept asking people, what are they lining up for? But I do get it. And it gets to this idea how people are looking for more than just the meal or the treat itself. It is really the experience. And you tapped into that. And I am curious, I mean, Bloomberg did a big feature on you. They mentioned how Howard Schultz, who led Starbucks for years, has been an advisor of yours. And I thought that was interesting because, you know, for the most part, I mean, frozen yogurt is a bit of a commodity, just like coffee was. But he was able to take coffee and really elevate it and make it into something that was a lot more desirable. I mean, what did he tell you? What advice did he give you?
I mean, he, you know, puts the customer at the forefront of everything. And really, his biggest piece of advice for me was, you know, go slow to go fast. And I think it's the biggest message that I can share with anyone looking to build a new company, which is, you know, we have to put the customer, we do put the customer at the center of everything, and it's all about that. So everything we do in trying to make the line fun and entertaining in the store and generosity and hospitality, everything we're doing is that. And I think, you know, he does better than anyone.
You have 2 locations in New York City. You're opening a 3rd. Yes. Is that correct? Yes. Do you worry, though, that as you try to scale up and expand, that maybe some of the mystique and the fun and the exclusivity of it gets lost?
Yes and no. We're not going to try put one on every corner for that exact reason. But I think there's so much demand, particularly in a city like New York. You know, people are constantly asking us to come to their neighborhood so they don't have to trek all the way down to us, let's say downtown. So I think that there's a way of doing it where we don't diminish what makes it so special, but still can like sort of be everywhere for everyone.
In addition to not putting it on every corner, there's also the issue of copycats, right? I mean, anytime something goes viral, something gets big, then everybody's going to try to find a way to knock off. How do you sort of protect yourself or protect your brand in a way where it will stand out once, you know, inevitably everyone else decides to try to do exactly what Amber Linz did?
To be honest, and it sounds cliche, but I'm not too worried about what everyone else is doing. I think so many of the brands have so much merit, like obviously the beautiful product and experience. We're really, really focused on what we're doing, which is how can we deliver that experience that's incredible every day and fun. Like it's meant to be fun. How do we make the line fun? We've got DJs, we've got live music, we've got poets, we've got artists. Like it's an enjoyable experience. That's what really what we're focusing on. And then at the product level, how do we make it a consistently super high quality product? Not just follow what's trendy of today, but actually focus on the ingredients, locally sourced, where's the best produce, that sort of stuff. So we're really focused internally.
All right. And I am curious, as you expand, is the ambition to go beyond New York?
Yeah, of course.
All right. Amber, great to have you here.
Thank you so much.
Amber Linz, the founder and CEO of Mimi's Frozen Yogurt. All right, as we wrap up here on the close, we're going to set you up for another busy day on Wall Street tomorrow. A lot for investors to parse, including more earnings. We got ASML, that was the big Dutch maker of chip equipment. We're going to hear from TSMC overnight, tonight, a big read on the AI trade. We're also going to get a big read on what's going on in other parts of the world. That includes General Electric as well as United Health as we start to get deeper into the heart of earnings season. Of course, the star of the show will be after the market tomorrow, right here on The Close. We are expected to hear from Netflix. High expectations, but also high anxiety, particularly on the back of some recent reports by Bloomberg and others about the strategy going forward. Over there with Ted Sarandos. On the economic front, we are going to get jobless claims and retail sales data. That comes out at 8:30 a.m. Washington time. And at 10 a.m., we're going to get an update on pending home sales. That's going to come all amidst more Fed speak. Kevin Warsh just wrapping up 2 days of testimony in Congress. We're going to hear from Lori Logan Schmidt as well as Jefferson tomorrow right here on The Close. And we all appreciate everyone here for sticking around and watching us and ignoring, well, the elephant in the room. 2-1 right now for all of you wondering. Balance of Power, they're coming up at the top of the hour right here on Bloomberg.